On Wall Street, money isn't just capital, it's power. And in 2012, one of the most dramatic financial battles of the decade wasn't fought over real estate, tech, or energy. It was fought over powdered shakes. The battleground, a multi-level marketing giant called Herbalife. The challenger, hedge fund titan Bill Ackman, who launched a billion-dollar bet that the company would collapse under its own weight. It was supposed to be his greatest trade. Instead, it turned into one of the most humbling and costly bets in hedge fund history. This is the story of how Bill Ackman lost $4 billion betting against Herbalife. Bill Ackman wasn't new to controversy. He built his hedge fund perishing Square Capital Management on big ideas and even bigger convictions. He didn't dabble in safe bets or index funds. He made concentrated, aggressive trades. He called out CEOs, demanded board seats, and reshaped entire companies from the outside. In 2002, he shorted MBIA, a bond insurer predicting its collapse, and he was right. He made hundreds of millions of dollars. In 2008, he sounded the alarm on the housing crisis. Again, he profited while others were wiped out. Wall Street came to see him as a genius, articulate, disciplined, and persuasive. But with that reputation came something else: ego. And ego would play a major role in what came next. In 2012, Ackman began quietly building a short position in a company he believed was a fraud, Herbalife. To the public, Herbalife looked like a global success story. With over $4 billion in annual revenue, it sold nutritional shakes, vitamins, supplements in over 90 countries. It wasn't the products that caught Ackman's eye. It was the business model. Herbalife operated as a multi-level marketing company, or a MLM. This meant distributors didn't just earn commissions from sales, they made money by recruiting other people into the system. Ackman's team spent months investigating. They interviewed former distributors, analyzed internal compensation structures, and ran forensic accounting model. Their conclusion? Herbalife's primary source of revenue came not from real retail demand, but from recruitment, people buying products just to stay qualified for commissions. In other words, a pyramid scheme. In December of 2012, Ackman made it public. At a conference in New York City, he unveiled a 342-slide presentation accusing Herbalife of operating illegally and preying on low-income communities, especially immigrants. He called the company a criminal enterprise. He claimed the majority of people who joined lost money, and he predicted that regulators would soon shut it down entirely. But this wasn't just talk. Ackman had already shorted $1 billion worth of Herbalife stock, a massive concentrated position. And to make things more dramatic, he pledged to donate any profits to charity. The trade, in his mind, was a moral crusade. But in the financial world, morality doesn't guarantee profit, and others on Wall Street saw opportunity in his overconfidence. Enter Carl Icahn. A legendary activist investor in his own right, Icahn has been a force on Wall Street since the 1980s, but he wasn't just any rival. He had history with Ackman. Years later, the two had clashed over a failed stock deal. The fallout was nasty. They sued each other, they badmouthed each other in the press, so when Icahn saw Ackman shorting Herbalife and doing it loudly, he saw red. Not only did he disagree with Ackman's thesis, he wanted to humiliate him. Icahn began buying up Herbalife stock, lots of it, and eventually he amassed a 25% stake, making him the company's largest individual shareholder. And then in 2013, it exploded into public view. The two faced off live on CNBC in what is now one of the most infamous TV moments in Wall Street history.
I want to be friends with you, Bill. I wouldn't be friends with
Carl.
you. And I would. You said to
Carl.
me you'd like to be friends so that we could invest together.
Carl, I have no interest. Do you think I want to invest with you? Okay, let's
I
move
would
on.
invest with you
Let's
if you were
move
the
on.
last man on earth.
It was personal. It seemed like Ackman might still win. He continued to apply pressure, lobbying the FTC, hiring former law enforcement agents, commissioning reports, and even launching websites to expose the company. He claimed Herbalife wasn't targeting Latinos or immigrants with misleading promises. He argued the entire distributor model was unsustainable, and he gave it some time, believing regulators would act. But behind the scenes, Herbalife was adapting. They revamped their compensation plans, they limited bulk product purchases, and they fought back hard. Herbalife spent millions on legal defense, public relations, and lobbying. They launched ad campaigns claiming to empower entrepreneurs. They fled distributors to Washington to testify on their behalf. Wall Street, watching the battle unfold, began siding with Herbalife. The stock climbed from the mid-30s to over $70 within a few years. Ackman's short position, still public, still huge, was now bleeding money. And then came the real turning point. In 2014, after years of pressure, the Federal Trade Commission opened an official investigation into Herbalife. It was the moment Ackman has been waiting for. He publicly stated this is the beginning of the end, but the investigation dragged on. 2 years later, in July 2016, the FTC finally announced its decision. Herbalife would not be shut down. Yes, they were fined $200 million and required to restructure their business. Yes, they had to improve transparency and change how they paid distributors, but they remained in business. No fraud charges, no collapse. Pyramid Ackman had bet would fall. Instead, it was reinforced. Herbalife's stock soared on the news. Ackman's losses ballooned into the hundreds of millions. At this point, most hedge fund managers would have cut their losses. Ackman wasn't most hedge fund managers. He held on. By 2017, Ackman had started adjusting the position, switching from a pure short to put options. Why? To limit downside risk. It was a quiet step back from the most aggressive part of the trade, without admitting total defeat. But it wasn't enough. The market kept rising. Herbalife kept climbing. Icahn kept winning. And finally, in early 2018, Ackman exited the position entirely. No press conference this time. No long slide deck, just silence. Reports estimate that Pershing Square lost over $1 billion in direct capital, but the full cost was higher. Some say $4 billion in total when you count opportunity costs, reputational damage, and investor redemptions. Meanwhile, Carl Icahn reportedly made over $1.3 billion on his Herbalife stake. He didn't just win the trade, he won the war. So what went wrong? At its core, Ackman's analysis might have been valid. MLMs are controversial, recruitment-heavy business models are risky, and yes, many Herbalife distributors did lose money, but in the stock market, timing is everything. You can be right too early and still lose everything, and when a trade becomes emotional, when it becomes about proving something to someone else, it's no longer rational. It becomes personal, and personal trades are dangerous trades. Ackman was fighting a moral war in a profit-driven world, and in that world, markets reward momentum, not morality. Even Ackman admitted this later. He said the Herbalife battle was the most humbling experience of his career. He said, quote, "Making things personal is a mistake. The market doesn't care about your feelings." He learned the hard way. So what's the real takeaway here? Don't confuse conviction with infallibility. Don't mistake principle for profit, and never forget, in the market, it's not about being right in theory, it's about being right in time. Bill Ackman may have lost a fortune betting against Herbalife, but his story is more than a failure. It's a masterclass in overconfidence, timing, and the limits of righteous investing. Thanks for watching. If you like this breakdown, subscribe to Money Minds for more stories of massive win, painful losses, and billion-dollar lessons from the world of finance. And remember, the market has no enemies, only winners and losers. Thank you.